Why do your best-looking trades keep failing? Why does price reverse the moment you enter? Why does it feel like the market waits for you to click buy just to punish you? Have you ever noticed something? You can study for months, you can add more indicators, you can refine your entries, yet your results barely change. So let me ask you a harder question. What if the problem was never your entries? What if the problem was never your strategy? What if the problem is that you've been looking in the wrong direction this entire time? Another question. When you take a trade, do you actually know where the market is trying to go? Or are you just reacting to what's happening on a tiny slice of the chart? Because here's the uncomfortable truth. Most traders aren't losing because they're bad. They're losing because they're fighting the natural order of price. They're swimming against the current and calling it a strategy. Think about how you currently trade. You open a 5-minute chart, you see a pattern, you see a candle formation, you see something that looks clean, so you take the trade. But you never ask the only question that matters. What direction is the market already committed to? Because price is never deciding on the 5-minute chart. It already decided hours ago, days ago, sometimes weeks ago. Lower time frames don't choose direction. They only express decisions that were made higher up the chain. Imagine price like a river. The monthly chart is the source. The weekly chart is the current. The daily chart is the flow. Intraday charts are just surface ripples. You can splash in ripples all you want, but if the river is moving south, you will never swim north, no matter how perfect your stroke looks. Here's the hierarchy. Monthly sets the macro direction. Weekly refines the intent. Daily defines the active path. Lower time frames only provide entry timing. That's it. Anything else is illusion. When you open a monthly chart, you're not looking at candles. You're looking at long-term institutional positioning. You're seeing where banks, funds, and large players have committed capital. Those positions are not emotional. They're not impulsive. They're planned months in advance. When price leaves imbalance on a higher time frame, it's unfinished business. Markets don't like unfinished business. They return to it. Not because of magic, not because of indicators, because massive orders still exist there. The weekly chart breaks that long-term intent into chapters. It shows where accumulation is happening, where distribution is happening, where transitions are forming. Weekly structure is the bridge between macro intention and active execution. Ignore it, and you're blind. The daily chart is where direction becomes actionable. This is where you decide, I am only interested in longs, or I am only interested in shorts. Not maybe, not both, not depends on the pattern. One direction. Clarity beats cleverness. Lower time frames are not decision charts, they are microscopes. You don't use a microscope to choose a destination. You use it to perform precise surgery. Most traders do the opposite. They start at the microscope. They stare at noise. They see 10 setups per hour. They feel productive, but they're just feeding randomness. Random entries create random results. Random results create emotional trading. Emotional trading destroys accounts. Here's how professionals actually approach a market. Start high, define direction, mark key zones, only then drop down, never the other way around. Let's walk through a real scenario. You check the monthly chart, structure is bullish, higher highs, higher lows, price respecting long-term demand. That alone tells you something critical. Your job is to look for buys, not sells, not reversals, not quick shorts, buys. Weekly chart shows price pulling into a major demand zone. That's not weakness, that's large players positioning. Daily chart shows a shift back to bullish structure. Now you have alignment. Monthly bullish, weekly supportive, daily confirming. Now and only now do lower time frames matter. You drop to the 4-hour. You're not asking, should I trade? You already answered that. You're asking,
Where can I execute efficiently? Price pulls into a daily zone, liquidity gets swept. You drop to 15-minute or 5-minute. You wait, not chase, not guess, not force. You wait for your model, then you execute. Not because a candle looked good, but because structure across multiple dimensions agrees. That's professional trading. Now, let me say something that will offend most traders. If you're using the 5-minute chart to decide direction, you are not trading. You are entertaining yourself. Because that chart does not control price, it reacts to price. Here's the brutal reality. When higher time frame and lower time frame disagree, higher time frame wins. Every time, no exceptions. You might survive a few counter-trend trades, but over hundreds of trades, probability will crush you. Another truth, institutions cannot enter large positions instantly. They need liquidity. They create moves that trigger stops. They encourage breakouts. They manufacture fear and euphoria, not to trick you, but to fill their orders. Higher time frames reveal this behavior. Lower time frames hide it. That's why zooming out feels boring and zooming in feels exciting. The market uses excitement to extract money. Let's talk execution discipline. Before your trading day starts, you must know monthly bias, weekly context, daily direction, key zones, written down, not in your head. Memory fails under pressure. Paper doesn't. If those time frames are not aligned, you do nothing. No trades, no small position, no just one try, nothing. Flat is a position. Patience is a position. Targets come from higher time frame objectives, not random risk-reward ratios. Stops go where structure fails, not where it feels comfortable. Structure defines risk. Structure defines reward. Your job is simply to participate. Now, let's talk psychology. When you trade with higher time frame bias, lower time frames will scare you. Pullbacks will happen. Consolidations will happen. Fake reversals will happen. This is normal. Professionals expect it. Amateurs panic. There are two types of patience: the patience to wait for alignment and the patience to stay in a valid trade. Both are rare. Both separate winners from everyone else. Most people want constant action. Professionals want clean opportunity. One high-quality trade per week can outperform 20 impulsive ones, not because of luck, because probability compounds. Accept this now. You will miss moves. You will watch price run without you. That is not failure. That is professionalism. You're not here to catch everything. You're here to catch what fits your model. Your edge is not prediction. Your edge is selection. Choosing when not to trade. Choosing only aligned conditions. Choosing discipline over dopamine. So here is the law you must burn into your identity. Price flows from higher time frames to lower time frames. Always. When you trade with that flow, you stop forcing, you stop guessing, you stop gambling, you start positioning. Respect the hierarchy. Build from the top. Execute at the bottom. Let structure guide you. Let patience protect you. Let probability work for you. Do this long enough, and your results will change. Not because you found a secret indicator, not because you got lucky, but because you finally stopped fighting gravity.